I'm going to kind of share with you some of the stuff that he shared with us. This first one is our U.S. annual existing home sales, and it's ready for a breakout. You see how, you guys all know I love trend lines. I don't like the noise of day-to-day what we hear in real estate. I like to watch trend lines because that tells us the long-term view of things. And we're well below where we should be on a trend line. Did we blow through the trend line in 01, 02, 03, 04, 05, 06? Yeah, we sure did, as a nation. But we have come down so far that we're well below the trend line now. And there's pent-up demand here. There are back in 1998, which was the last time we were selling this number of homes, since then there have been 40 million people born in America. Every single year we had 3 million people. If that's not pent-up demand, I don't know what is. They can't all live in the same house forever. You know, mom and dad aren't going to let them live there forever. They can't stay in the same apartment with their college roommates their entire lives. So sooner or later, something's going to have to change. Go to the next slide, Jim. This is the months of existing home sales. You see how we had a spike? Remember the tax credit? Mm-hmm. And then the tax credit got renewed, and we had another smaller spike. And then all of a sudden, I don't really remember this, but we had a big drop-off because that was unsustainable growth. That was fictitious growth in the housing market. It wasn't something that was because of consumer confidence or people wanting to buy houses because they saw a value in the tax credit. But we've seen that really level off here again in the last couple of years, back to what we saw back in 08 levels. So hopefully that's showing that we've seen a leveling off here and we're starting to hit a bottom. Go to the next slide. Record low interest rates. I hope you guys know the Fed fund rate doesn't actually dictate what happens in interest rates. The mortgage bond market actually dictates that. But what the Feds have done is bring down the lending rate between banks to zero. Now, I said a year ago we couldn't have interest rates any lower than they were then. I was wrong. They've come down another 1% since then. But if the Fed fund rate is at zero, it's going to be very, very hard for your buyers to find a better interest rate in the future. Because the Fed's not going to give money to the banks in order for them to lend to other people. It's not going to happen. We're at zero on that Fed fund rate. Next slide. So we had a depression for a couple of months. See those lines below the mark in 08, 09? And then we bumped back up. That's when we heard all the news. We're out of the recession. I'm sorry, they didn't call it a depression. I think a depression is a longer line than 2 or 3 months. We had a recession. But it doesn't feel like we came out of a recession because we never got back to 4% GDP. So that's something we're still going to have to watch is the consumer confidence. When we get above 4% GDP, more people are going to feel confident spending in this market. But right now we're kind of bouncing along around 2% GDP. Next slide. Gross domestic product. That's how much stuff we're sending out into the world, how much sales are happening, retail, that sort of stuff. That's all gross domestic product. Consumer confidence is in the tank. Again, this goes back to jobs and people not feeling comfortable going out and spending right now. That's still something that's going to be a lag on our economy. As long as people don't have jobs and they don't feel comfortable going out to buy something, we're going to continue to see lagging behind where we should be on home sales. Next slide. North Carolina home sales. Again, if you look at the trend line, let's say this is our trend line. We went above the trend, but we've come down severely since then. You know, I've been telling you the last couple of months that I feel like we've really seen a bottom forming. Well, that's what we're seeing over there. You see how that little U is forming over there? That's a bottom graph. If you ever study charts for stock markets and that sort of thing, that's what they call a bottom. And we're seeing that form over there. Now, if it drops off again, we have to watch that. But it sure looks like there's a bottom forming right here. And that's really, really good for us. Next slide. And I'm making Jen skip all around on pages here. So U.S. housing starts were very low. This is our new construction inventory. And we saw it kind of jumped up back in 06, 07, and then the bottom just fell out of new housing starts. I mean, everybody was getting out of new housing starts because they had overbuilt in many parts of the country. But we're at 500,000 new home starts now. That is not a level that is sustainable. We can't just continue to sell existing homes when there's 40 million more people in the market than there were in 1998. At some point, we're going to have some new construction. I always thought that, well, when we need new construction, the builders will come back, they'll come back into the market, they'll retire their subs, it'll be a gradual process. He brought up a very good point, that the problem is the new construction can't get lending. The lending that is happening is in USDA, FHA, and that's because it has government backing. They're not lending to construction and to investors because they don't have the government backing if somebody defaults on that loan. So we have a serious problem with getting new construction back into this market. It's not going to happen overnight because the banks have to loosen up and take some risk, which right now they're very risk averse because of everything that's been happening to them in the global economy. Next slide. So this is the newly built inventory. Look at that slide. I mean, it's a hill. It's gone. The new inventory is out of the market. Next slide, we'll look at the Charlotte market. These are the new home housing permits. So these are new starts. They've gone and gotten a permit to get to a CO, to get to a certificate of occupancy. We're back at 1988 levels of permits.
Who remembers what interest rates were in the 1980s?
18%.
18%.
18%. We're at 4,
Let's
3.5.
put that in perspective.
I mean, it's crazy that we're at that level of new construction permits right now. Next slide. I'm making her skip page 23 and 3. And
23 here for you.
I want to show you real quick the rent index, because I, as an investor, have watched this pretty critically, because I thought when we started seeing the foreclosures and short sales, I'm like, yes, rate increases. Finally, rent increases are coming. But we didn't see that. What happened was we had these onesies and twosies, people putting their house on the market for rent instead of selling it because they weren't willing to short sell or foreclose. Well, now a lot of those things are actually coming on the market because those people realize this market's not turning quick enough for me to get out. So we started seeing that come back into that shadow inventory of the banks. But there is very little rental property available in this market because those people that have had to move out of their house and can't buy have to rent. But they're not including investors in the banking pool. It's very hard for an investor to get a loan unless they got 20% down. It takes a while for an investor to build up 20% down on rents every month. But it's coming. Rent rates are going up. It started happening because of supply and demand. There's not enough supply in the market for the rental inventory. Now that's good for us as far as selling properties too, because once rent rates rise, we also see home prices rise. They almost always over history have gone the same. We saw them in 07, 08. All of a sudden prices went high, rent rates didn't, then prices dropped below, and they've got to get back up to the rent rates on the rise. So we've started seeing some bouncing around a little bit. But if rent rates are going up, house prices are going to go up. Because people are renting for $1,000 a month, they feel like I can afford a mortgage of $1,000 a month. If all of a sudden the rate goes to $1,200, they feel like, well, I can get an $1,150 mortgage, and they can buy a house. Next slide. So jobs. I say this every single time that it's all about jobs. And we are seeing the job pool, the number of new people coming into unemployment has decreased. We've seen it kind of level off over the last year. But it hasn't gone into a scenario that we're actually seeing a lot of job growth yet. But it's getting close. The Charlotte long-term job market is very good. And that's true throughout the South, actually. And we know why these things are happening. People want to move here because of climate. They want to move here because of our locations, beaches and mountains and entertainment and a great place. We've got great schools in this area. There's a lot of good things that are happening here. I was at a developers council meeting yesterday, and they were talking about when new companies come into an area to bring a company, the first thing they look at is the education system. Because they want to know that they are going to have an education pool of people, but they also want to know, I'm going to bring my people here, they're going to be happy with the education that their kids are going to be getting. So those are very, very good signs for us in this area. But if you look at the trend line, we've kind of hit a level there that's below the line. that we should see a turn to the positive in our job market. Last slide. Last slide right here.
Yep.
I'll just let you read through some of this, but I just want to reiterate that we are seeing rent rates on the rise. And there aren't very many investors that have cash in this market to buy rental properties to put more inventory out there. So we're going to see a crunch of rent rates on the rise, and we're going to see housing inventory go up, or the prices go up as well with that. Decreasing supply of homes. They say we have some shadow inventory left out there with the banks that they're holding on to, that they're going to put into this market. If I'm right about what's getting ready to happen, I hope there is some shadow inventory, because there's not going to be new construction inventory for quite a while. That's going to lag way behind. We're going to need some inventory in the market. I just listed a house yesterday, put the side of the yard. It was in an area that has 5%, a 5-month inventory available. Remember a balanced market, 5 to 7 months? That particular zip code has 5 months of inventory available. Put the sign in the yard. I had a call within 30 minutes on the sign. I finally got it in last night at 1 o'clock in the morning. This morning there was an appointment set by another agent at 9 o'clock. Remember those days? There's pockets that's already happening here. It's not in Mooresville. This is actually over near the Davis Lake community in that area, which is a really nice community, has good schools. But it's coming again, folks. If I'm right, I could be wrong.
No.
And anything could happen. We could see major things happen in banking with the euro and with Greece. I mean, there's a lot of things that could happen that take us off track. But I think there's some pent-up demand in this market, and we need to be letting buyers know that you're not going to steal properties anymore in this market. I don't believe. I'm done.
Are you looking at me like I'm supposed to say something?
I don't know. I don't know.
Great job. Aren't we so fortunate to have people like Todd that goes and wastes through all that information, all those hours at the board, and then gives us clip notes? Isn't that awesome?
Todd always makes me feel better after I leave here, you know? I feel a little more positive.
Okay, so our core services people.